two of the most valuable companies on Earth, both deep into AI, both printing cash, but the data shows only one is pricing in realistic growth. The other may be overpriced at current levels. By the end of this video, you will have a complete signal score for both. 5 factors. Evidence-backed, no opinions. In 2026, both companies are no longer just software businesses. They are AI infrastructure plays. Microsoft embedded OpenAI models across Azure, Office 365, and GitHub Copilot. Azure AI revenue grew over 35% year-over-year in the most recent quarter. Alphabet responded with Gemini 2.0 across Search, YouTube, and Google Cloud. Cloud revenue crossed $12 billion per quarter for the first time. Here is the problem retail investors face. Both look strong on the surface. The question is, which is better priced for what it delivers? That is exactly what the signal score resolves. Let us run it. The signal score rates each company across 5 factors. Each factor is scored 1 to 10. Maximum total is 50. The 5 factors are business quality, valuation, momentum, risk, and sentiment. We rate each one independently. No guessing. No vibes. Factor 1. Business quality. Microsoft generates revenue across 3 nearly equal segments: productivity and business processes, intelligent cloud, and more personal computing. Operating margins run near 45%. Free cash flow exceeds $80 billion annually. Azure is the second largest cloud platform globally. GitHub Copilot now has over 1.8 million paid subscribers. The diversification here is genuine. No single product drives more than 35% of total revenue. Alphabet, Google, score. 710 Alphabet still derives roughly 75% of revenue from advertising. That is a concentration risk. However, Google Cloud is the fastest growing segment, up over 28% year-over-year in 2025. YouTube advertising crossed $36 billion annually. Waymo and DeepMind represent optionality with uncertain timelines. Business quality is strong. The advertising dependency keeps it 1 score point below Microsoft. Factor 2. Valuation. Microsoft MSFT score 510 Microsoft trades at approximately 34 times forward earnings. That is a premium by any historical standard. The PEG ratio, PE divided by expected growth, sits near 2.1 historically, above 2 signals overvaluation risk. The price assumes Azure continues growing at 30+% annually. Any deceleration reprices the stock downward. The data shows Microsoft is priced for perfection at current levels. Alphabet, Google, score 710 Alphabet trades at roughly 22 times forward earnings. That is below the S&P 500 average for a company of this quality. The PEG ratio sits near 1.3 based on the numbers. That represents relative undervaluation versus peers. The market is discounting Alphabet due to AI search disruption risk. That creates a potential valuation gap. If the AI threat to search proves less severe than feared, the re-rating could be significant. Factor 3. Momentum. Microsoft MSFT score 710 Microsoft is up approximately 18% over the trailing 12 months as of mid-2026. That outpaces the NASDAQ 100 by about 4 percentage points. Revenue growth came in at 17% year-over-year in the most recent quarter. Earnings beat consensus by 6%. Analyst estimate revisions have been positive for 3 consecutive quarters. That is a reliable momentum signal. Alphabet, Google, score 610 Alphabet is up roughly 12% over the same period. It has underperformed the NASDAQ 100. Cloud segment growth is accelerating, but search revenue growth slowed to 9% year-over-year, below the prior year rate. The stock is range-bound. Institutional positioning has been cautious. Momentum is present but not strong. Factor 4. Risk. Microsoft MSFT score 610 Microsoft faces three primary risks. First, Azure growth deceleration as the AI spending cycle matures. Second, OpenAI dependency. Microsoft does not fully own OpenAI. Any strategic shift at OpenAI creates uncertainty. Third, antitrust exposure. The Activision acquisition drew regulatory scrutiny. The Copilot bundling model may face similar review. Balance sheet is pristine. Net cash position exceeds $30 billion. Financial risk is low. Alphabet, Google. Score. 510 Alphabet faces a more acute structural risk. AI-powered search alternatives threaten the core business model. ChatGPT, Perplexity, and Microsoft Copilot are all absorbing some search query volume. The data shows this trend is real. Alphabet also faces ongoing antitrust litigation. In the United States and European Union, remedies could include forced divestiture of Chrome or search distribution agreements. These risks are not existential, but they are real, and they are not fully priced in at consensus estimates. Factor 5. Sentiment Microsoft MSFT. Score. 710 Approximately 88% of sell-side analysts rate Microsoft to buy or outperform. Consensus 12-month target implies about 12% upside. Institutional ownership is at an all-time high. Short interest sits below 1% of float. Minimal bearish conviction. Retail sentiment on social platforms is strongly positive. The risk here is sentiment being too crowded or Alphabet, Google. Score. 810 Alphabet has approximately 83%. Buy ratings. But sentiment has been improving from a lower base. Short interest has declined for 6 consecutive months. That is a meaningful shift in institutional positioning. The narrative is shifting from AI threat to AI beneficiary. As Google Cloud and Gemini gain traction, sentiment re-rating is underway. Improving sentiment from a skeptical baseline is historically more predictive than persistent optimism. Full comparison table. Signal factor, business quality, Microsoft score, 8-10, Google score, 7-10, Microsoft evidence, 45% OP, margin Azure diversification, Google evidence, ad concentration risk, cloud accelerating. Signal factor, valuation, Microsoft score, 5-10, Google score, 7-10, Microsoft evidence, 34x FWD PE, PEG 2.1 priced for perfection. Google evidence, 22x FWD PE, PEG 1.3 discount to growth. Signal factor, momentum, Microsoft score, 7-10, Google score, 6-10, Microsoft evidence, plus 18% TTM, 3 consecutive EPS beats. Google evidence, probably 12% TTM, search growth slowing. Signal factor, risk, Microsoft score, 6-10, Google score, 5-10, Microsoft evidence, OpenAI dependency, antitrust exposure, Google evidence, search disruption risk, DOJ litigation. Signal factor, sentiment, Microsoft score, 7-10, Google score, 8-10, Microsoft evidence, 88% buy, crowded trade, risk, Google evidence, improving from skeptical base, re-rating. Both companies score 33 out of 50, a statistical tie. But the composition tells a different story. Microsoft wins on business quality and momentum. Alphabet wins on valuation and sentiment. Based on the numbers, Microsoft is the higher quality business. Alphabet is the better priced opportunity at current levels. The decision depends on what you are optimizing for. Quality at a premium, or value with improving fundamentals. Common mistakes. What retail investors get wrong. The most common mistake is anchoring to brand familiarity. Retail investors consistently overweight Microsoft because it is in their daily life, Teams, Office, Windows. Familiarity is not a valuation signal. The second mistake is ignoring the PEG ratio. A company growing at 15% and trading at 34 times earnings is mathematically less attractive than a company growing at 17% at 22 times earnings. The math is straightforward. Third mistake, treating AI headlines as earnings. Both companies have made AI announcements that moved their stock. Historically, AI revenue contribution is still a fraction of total revenue for both. The data shows that what you pay matters as much as what you own. At equal quality scores, valuation is the differentiating factor. Two world-class companies, identical signal scores. The data reveals the tie is only superficial. If you optimize for business quality and institutional momentum, Microsoft is the answer. If you optimize for value and sentiment tailwind, Alphabet is the better position at current prices. Neither is a mistake. Paying the wrong price for either one is, if you want to see the full signal score on NVIDIA, it drops Thursday. Subscribe and turn on notifications.